Inflation is back. On that, basically everybody agrees. However, an intense debate is currently raging about whether inflation is here to stay or whether it's just a temporary blip. The position that inflation is high now but will soon return to its normal level is championed by Team Transitory. This team consists of heavy hitters such as Treasury Secretary Janet Yellen, ECB President Christine Lagarde and Nobel Prize winning economist Joseph Stiglitz. On the other side of the field we have Team Persistent, which believes that inflation is here to stay and might even increase in the near future. It is represented by prominent economists such as Larry Summers and by central bankers such as ex-president of the German Bundesbank Jens Weidmann, and also very vocally by investors such as Peter Schiff. But who should you believe? Hi, I'm Joeri, and in this video I'm going to help you make sense of it all. I will first go over the basics of inflation. Then I will summarize what might be causing it, and then for each cause why Team Transitory and Team Permanent believe what they believe. What's more, for each case, myself and UK academic, YouTuber and rebel of the economics profession, Earn Learning Economics, will evaluate the evidence and also the case made by both Team Transitory and Team Permanent. Okay, let's quickly review the basics. Inflation is a simultaneous increase of all prices in the economy. So, this does not mean that all prices have gone up by the same magnitude. It just means that on average, all prices have gone up. This sounds straightforward in theory, however in practice inflation is insanely difficult to measure. After all, to measure average prices you would have to keep track of both the size and the price of every transaction in the economy. In most economies this is not possible because privacy laws prevent them from going through your bank transactions. And even if they could, it's surprisingly difficult to determine what has been purchased just from bank records. If you don't believe me, just have a look at your friend's bank account statement from last month and try to figure out what it is they purchased. To get around these problems, economists have constructed a basket of goods and services that's supposed to represent what a household spends on average. This is the Consumer Price Index, or CPI for short. For each good or service, the CPI index not only consists of a price but also of a weight that reflects how important this good or service is for households on average. For example, since average households spend a lot on rent each month but not on supporting this channel via Patreon, an increase in rents will affect the CPI a lot, whereas me increasing the price tiers of my Patreon will not. So what are these weights? Well, as you can see here, in the USA and Europe the weights are fairly similar. The bulk of household expenses go to housing costs as well as to food and transportation. However, when comparing inflation in Europe and the States, one notable difference is the inclusion of house prices. Controversially, neither the European nor the American CPI includes housing prices directly. I know, this sounds absolutely mad since housing prices have gone through the roof in both areas. Importantly, housing prices have risen much faster than rents, which are included in the CPI. However, you can't just include house prices in the CPI for two reasons. The first is that houses are not just used for consumption, they're also used as an investment. And the dynamics of consumption and investment goods are very different. Simply put, you as a consumer would not be very happy if the price of, I don't know, graphics cards would go up. But if, say, you invested in GameStop stocks and its price went through the roof, you would be very happy. The second reason why you can't just include house prices is that the price of a house is not really reflective of what it will cost you. And the main reason for this is that most people borrow money to buy a house. For example, I just bought a house at a price that was much higher than what my parents did. However, I borrowed at close to a 1% interest rate while my parents borrowed at closer to 8%. You'd have to take this into account in the CPI. To deal with these problems, in 1983 the Americans added a new category to the CPI, which is called Owner's Equivalent Rent. Owner's Equivalent Rent gets around these problems by just asking homeowners a very simple question. If someone were to rent your home today, how much do you think it would rent for monthly, unfurnished and without utilities? The idea here is that if house prices go up like crazy, homeowners' equivalent rent would go up like crazy. But if mortgage interest rates go down, like they have in Europe and the United States, homeowners' equivalent rent will rise far slower than house prices. As you can imagine, this measure is far from perfect. However, it's much better than just leaving it out as the Europeans have. After all, how much does rent alone say if, like in the Netherlands, about 69% of the population is a house owner and not a renter? So with these weights known to calculate CPI, economists simply retrieve the average price for all items in the basket and multiply it with their respective weights. To then calculate yearly inflation, all economists need to do is look at yearly changes in the CPI. Simple, right? Well, not really, because CPI weights have one big problem, and that is that they change over time. After all, if the CPI was calculated in 1910, there was likely a significant weight on the price of candles. However, the weight for the price of internet would be non-existent. Therefore, economists need to update the weights of the CPI every so often. However, here the pandemic and especially lockdowns caused massive problems for the CPI because they changed consumer behavior virtually overnight, while the CPI weights had already been determined by the start of 2020. Simply put, in 2020, households started buying far more goods and far fewer services. This pushed up the price of goods more than it made the price of services drop. At the same time, this drastically increased the number of goods that people consumed, but not their weight in the CPI. Therefore, actual inflation in 2020 was likely quite a bit higher than official inflation. Taking this into account, research by Harvard professor Cavallo estimated that the official CPI was likely 0.8% too low. This can partially explain why we see such shocking inflation numbers today. But then the question becomes, by how much? Well, according to my own calculations, if Professor Cavallo was right, then inflation in the US would now be about 5.3% rather than the officially reported 6.2%. While that is still a very high number, it does demonstrate that we shouldn't just look at headline inflation numbers and use them to produce sensationalist YouTube videos. Another reason is that lockdowns also messed up the service price data collection. For example, while they were closed, restaurants did not technically have a price. This means that while the fundamental factors driving up restaurant prices, like food prices or wage prices, were still going up, economists weren't really able to see that in official restaurant prices because they weren't being posted. Therefore, they just assumed that these remained the same that year. Sadly, I couldn't find a good estimate for how big this effect was. However, it does mean that inflation in 2020 was likely even more understated, and thereby that inflation today is likely even more overstated. The combination of these two effects have been dubbed base effects. Base effects are mostly emphasized by Team Transitory in an attempt to reassure us that super high inflation numbers today will likely come back down once the pandemic stops messing with the statistics.
Inflation collapsed last year when lockdowns were imposed, which is creating strong base effects as activity recovers.
That being said, some of us are still in lockdown and a lot of us are still afraid to visit restaurants or travel. So it could be that inflation is still understated today. But even if current headline inflation numbers are overstated due to base effects, Team Transitory and Team Permanent still agree that inflation is very high today. So the debate is still on. But before we assess both positions, we need to do a quick recap of the three main ways that inflation can come about. But first, if you are watching this video, it likely means that you are intrinsically motivated to understand inflation and also recognize how complex this problem really is. So if that is you, then I'm happy to report that the sponsor of this video has an economist/treasurer job opportunity for you. For the economist part, you will be asked to figure out how to create a global stablecoin that is stable but not really backed by one single fiat currency like the US dollar. For the treasury part, you will be asked to get hands-on and manage a portfolio of assets that aligns with that goal. Now, honestly, I believe that this is a very unique and interesting job because I had just recently had a very candid and open conversation with the CEO of the Reserve project that's offering this job, Nevin Freeman. If you want to know more about the Reserve project, I've linked to the highlights of that conversation in the description of this video, and I've also linked to the job application itself there. To understand what causes inflation, economists typically use the age-old concept of supply and demand. However, for a macroeconomic concept such as inflation, they use total, also known as aggregate supply and aggregate demand. You see, if aggregate demand rises faster than aggregate supply, average prices will rise. And if aggregate supply rises faster than aggregate demand, prices will fall. Now, what's nice about this framework is that it helps us better understand inflation by breaking down this complex problem into smaller pieces. For example, if aggregate demand rises faster than aggregate supply, economists classify this as demand pull inflation. On the other hand, if aggregate supply falls but aggregate demand stays the same, they call this supply push inflation. Now, both teams recognize that we've seen a perfect supply push inflation storm these last few months. The first big contributor to this has been a massive energy crisis. But there's not really one cause for it. Part of this story are flooded coal mines in China, fires in Canada, political unrest and uncertainty in countries such as Libya and Venezuela. Another part of the story is that certain princes in Saudi Arabia have turned off the oil tap, and that certain presidents in Russia have turned off the gas supply for political reasons. But there's also just an energy sector that had not really invested for quite a long time because oil and energy prices had been so low for so long. Then global COVID lockdowns have contributed in two ways. First, they've shut down production in the countries that have been affected. For example, a renewed shutdown in Malaysia, where a lot of chips are packaged that are used in cars, have forced Ford Motor Companies to shut down its production of the new F-150 trucks. The second effect of COVID lockdowns has been to disrupt global supply chains, for example by shutting down ports in China. In a global supply chain that ran on maximum efficiency but minimal buffers, this has greatly increased transport prices. And on top of that, it also slowed down production, contributing to supply push inflation even more. By how much, you might ask? Well, in all honesty, this is very difficult to properly estimate. But just to get an idea, researchers at the Bank for International Settlements have recently given this a try, and they estimate that without supply chain disruptions, inflation would have been at least 2.8 and 1.3% lower in the USA and Europe respectively. And you know what? Even Larry Summers from Team Permanent recognizes this.
Annual inflation in last month, according to core CPI, was above 10%. Majority of that is surely transient.
For a large part, the disagreement is just about how long these supply chain disruptions will last. Here, the position of Team Permanent is best captured by the following quote from German central banker Jens Weidmann. The supply-side bottlenecks of the kind we are seeing for semiconductors might turn out to be more persistent. In addition, if we want to meet the climate targets, there will be no getting around significantly higher carbon prices. That will drive up energy prices for many years. On the other hand, Team Transitory members like ECB President Christine Lagarde have stated that they expect supply chain disruptions to end early next year. Although that quote was from before the emergence of this new COVID variant. The most extreme position taken by members of Team Transitory is best illustrated by the concept of a bottleneck economy introduced by the Financial Times' Martin Sandbu. He thinks that our current supply chain situation is comparable to having a ketchup bottle where we're shaking and shaking and shaking and nothing is coming out, thanks to backed up supply chains. But as we speak, big manufacturers are building new factories and containers all over the world. And once these are done, the product ketchup might come out all at the same time. This will potentially lead to severe supply push deflation. To a certain extent, this has already happened with lumber and steel, which were huge concerns at the start of the pandemic, but have since come down in price. So, Joeri, what do you think about the supply chain push inflation effect? And which team is more right than the other team?
Well, generally speaking, I do think that supply chains are something that we need to be worrying about if we're talking about inflation. Looking at specific goods and sectors and how they're being affected by things, whether it's the pandemic or not, is really important. And that's especially true for things like energy, which you've been discussing, which obviously underpin the whole economy. So I do think that this is the right place to look. In terms of whether this is going to be permanent or transitory, it seems to me that a lot of this has been affected by the pandemic, and they are going to be transitory factors, most of which are going to go away. But I'll say that with one possible caveat, which you raised, which I think is really important. Again, energy. If we see, further disruptions due to climate change, and if we see governments shifting away from non-renewable energy not in a smooth fashion, then we might see further problems, and those can have an effect on the rest of the economy. So energy is definitely, out of all of them, the one to watch out for the future. But in terms of the immediate danger, I don't think there is too much to worry about.
Yeah, all right, fair enough. I think that I broadly agree with that. The one thing I would like to add is that I was quite confident about the effect of lockdowns going away, but with the vaccines efficacy waning a little bit, and with Delta being sort of much more ravaging, especially emerging market economies where a lot of these factories are, I think that it will obviously also be transitory in the long run, but might actually take quite a bit longer than we expected.
Yeah, I think it's important to caveat that transitory basically means for as long as the pandemic and lockdown persists. And you're right, not enough is being done to make sure that globally we actually, move past the pandemic as much as possible.
And when it comes to the energy one, I also broadly agree with you. And I see also the concern from Jens Weidmann specifically about this actually taking longer. But I did also read some interesting articles from Adam Tooze, for example, whom you might know, stating that this sort of climate change factor is a bit overblown. And what they cite is sort of evidence that after the Paris Agreement, there was not really a lot of less investments into fossil fuel industries, and that it could also very much be a consequence of energy prices dropping significantly in 2015, I think it was, and that this industry is super cyclical, right? So that investment not being done then might still reverberate today, and hence we might actually rather quickly see a reversal of fortunes there. What do you think of that one?
Yeah, I haven't read that Tooze article, but that sounds absolutely sensible to me. I mean, certainly, it's about how the transition is managed, right? And as long as there aren't, too many sudden changes, then I think that we should be able to cope with the transition. And as long as there's enough investment in renewable energy to replace the non-renewables, then it shouldn't be a problem. But I think it's definitely, something to keep an eye on.
Now, what happens if people try to buy so much stuff that an economy's production just can't keep up? That's right, demand pull inflation. And this is the one that gets team members on both sides really worked up, because these millionaires and billionaires are just really concerned about the fate of the lower and middle classes, of course. For example, investor Peter Schiff from Team Permanent typically stresses the dangers of giving free money to people who don't produce anything. This is what happened under COVID.
We were expanding the money supply. At the same time, people were not working. People were leaving their jobs. They weren't being productive. They weren't producing goods. They weren't producing services. Yet the Federal Reserve flooded the economy with new money. And so even though people didn't work, they were spending more money than they did when they were still employed. And so you have all this money chasing a declining supply of goods and services, and so prices are exploding.
And he typically argues that the resulting inflation will come at the expense of the middle class. After all, they spend most of their income on the goods and services that will be affected by inflation. At the same time, Nobel Prize winning economist from Team Transitory, Joseph Stiglitz, argues that more demand than supply is actually good for the lower and working classes because it increases wages.
So that you're absolutely right. I'm welcoming this tight labor market. The only time the United States has succeeded in including marginalized groups into the labor force, reducing inequality, is when we have a very tight labor market.
This contradiction may seem confusing at first until you realize that they are talking about different channels of demand pull inflation. You could say that Peter Schiff is talking about the money printing channel and Joseph Stiglitz is talking about the overheating labor market channel. Let's tackle the one that the internet loves the most first, money printing. To view money printing as the source of all price inflation actually has a very long tradition in economics. The most prominent economist to support this idea was Nobel Prize winner Milton Friedman, who said that
the reason we have have inflation in the United States, or for that matter, anywhere in the world, is because these pieces of paper and the accompanying book entries, or their counterparts in other nations, are growing more rapidly than the quantity of goods and services produced.
His thinking was inspired by one of the most famous equations in economics, the quantity theory of money, which states that the money supply times the velocity of money must be equal to the total prices in the economy times the quantity of products in the economy. This equation is true by definition. You can see that when you look at the following example. Imagine that in an economy there were $2 and there were also 2 loaves of bread. Now these loaves of bread exchanged hands once. What was the price of these loaves of bread? Well, you can easily see that it was $1. Now in itself, this equation is just an accounting identity, which basically means that it only tells us that there will be some relationship between these variables, but it doesn't tell us what that relationship will be. Crucially, Friedman-inspired economists often assume that the velocity of money and production are roughly constant. Remember that clip from Peter Schiff arguing that stimulus checks for people who were staying at home due to COVID would be inflationary? Crucially, he made the implicit assumption that this didn't prevent a further collapse of production. If the money supply is indeed increased and velocity stays the same and production stays the same, then this new money must create new demand, but so indeed prices should go up. And then it makes sense to say that
everything is getting more expensive, and if people think that's transitory, it's because they don't understand the problem. In fact, they don't even understand inflation or where it comes from, because inflation is about money. You're inflating the money supply. That's what's being expanded, and none of this is transitory because these deficits aren't transitory. The money printing isn't transitory. It's here to stay, and that means prices are going to keep going up because we continue to destroy the value of the dollar as we expand the supply.
Sounds pretty convincing, right? However, the monetary theory of inflation has almost completely disappeared from universities. Why, you might ask? Well, because the data just doesn't support the simple explanation for most economies. For example, check out this graph of the CPI in Europe and compare it to the M1 printed by the central bank money supply in Europe. You can clearly see that while the money supply has accelerated, price growth has slowed. To a lesser extent, this disconnect also counts for the USA. But if you really want to see this simple theory fail, you only have to look at Japan. Even if we take into account the more expansive M3 money supply, which also contains money created by private banks, and compare it to the CPI, we can clearly see that M3 went up like crazy in Japan, whereas the CPI just had its ups and downs. What can explain this disconnect? Well, if we keep using the quantity theory of money, it must mean that either production has increased or the velocity has slowed down, or a little bit of both, of course. If velocity indeed slowed down, then this means that people started saving more of that new money and that asset prices should have gone up and interest rates should have gone down rather than inflation. And indeed, in Europe and Japan, we have seen massive rises in asset prices and interest rates fall down spectacularly. At this point, members of Team Permanent might say, okay, but people will start spending that money at some point, and when they do, then we will see this rapid increase in inflation. But again, if we look at Japan, they have been waiting for roughly 30 years now. So Team Permanent should come up with an explanation why people are going to start spending this saved money. The only explanation I could find was the one put forward by economists Charles Goodhart and Manoy Pradhan, if I pronounce that correctly. They say that as people got older, they were saving for retirement, but as many countries are now aging, the elderly should start switching from saving more to spending more. However, Japan is again a problem because here this didn't happen. However, the authors argue here that Japan is unique because here the Japanese companies really moved a lot of production overseas to other Asian economies that didn't really have this aging problem. And as the world in total gets older, this wouldn't be possible anymore. But okay, that is the future. What about inflation today? Because let's face it, saying that increases in the money supply doesn't have to push up inflation doesn't mean that it never will push up inflation. And indeed, even members of Team Transitory, such as Joseph Stiglitz, recognize that by giving money to the poorest in society, at least in the United States, this likely has contributed to inflation. However, he says that this is just a temporary blip because
the fiscal support is coming to an end, and I'm firmly of the belief that it's the fiscal support that's made the most difference.
Two questions that I want to discuss here with Unlearning Economics are: one, how important is the monetary factor? And two, how likely is it that government will continue stimulating the economy? All right, Joeri, what do you think about these 2 points?
Well, I think the monetary factor is perhaps more indirect than people like Peter Schiff have thought, but perhaps than economists in general have thought for the past few decades. I mean, if you look at things like the effect of interest rates on business decisions, it actually seems to be relatively small. The economist Nathan Tankus has written quite a lot on this. And I think that what you've seen really over the past few decades is, especially in the USA and also in the UK, is that the back of the labor movement has been broken. And so what you've had is, you know, a decline in union density, and you had people like Paul Volcker who were obsessed with unions. And you've seen actually, you know, wage growth has been relatively subdued, even with low unemployment. So I think that has played a really big role. Perhaps more so than monetary factors. And so I think people end up overstating the role of monetary policy. And especially with someone like Peter Schiff, what you get is he's almost defining inflation as an increase in the money supply, when of course that's not what inflation means. What inflation means is the increase in prices, which may or may not result in the increase in the money supply. And, you know, we're just not seeing the kind of increase in prices that people like him are predicting.
Yeah, this is actually interesting because a lot of people often tell me this in my comment section as well, that they say that inflation is actually an increase in the money supply. And then I looked it up, and apparently this was the old definition of inflation in the early 19th century. But I totally agree with you that it's very confusing to mix up old definitions with new definitions.
Absolutely. And I mean, you know, that definition of inflation has some use, as, you know, we need to understand what's happening to the money supply. Why are people worried about inflation? Well, I don't think, you know, the aggregate M2 measure of the money supply is really of much concern to most people. I think they're worried about prices and wages and how those things affect them. So I think, you know, whatever you want to call it, maybe we can call it something else, but we're not seeing the rise in price that people like Peter Schiff are predicting.
And what do you think of using the quantity theory of money in general in this type of context? Is it still useful?
Well, this is a big debate, isn't it? I'm of the opinion that it's probably done more harm than good, which isn't the same as saying it can have absolutely no use. But generally speaking, I think it kind of overstates the degree of control that the central bank has on the money supply that's actually in circulation, right? So by itself, the quantity theory of money doesn't do this. It's just an identity, but it has led to these kind of overstatements. And you saw this with targeting the money supply, right? The more extreme version of monetarism, when they tried that based largely on reasoning from the quantity theory of money, it didn't really work. And just more generally, I think the mechanism from central bank action, central bank interventions into financial markets, and an expansion of the money actually being used in circulation, that mechanism is much weaker than we think. And therefore, I don't think that, you know, increase in M, therefore increase in PY is a very reliable mechanism.
Yeah, right. Yeah, I totally agree. And I think most academic economists also agree, and that's basically why they stopped using the quantity theory of money that much, because especially when you look at velocity, that has just totally been fluctuating wildly, and especially it seems that a lot of money that used to be chasing goods and services is now finding its way to financial markets, therefore leading to financial market inflation and not regular inflation, right?
Absolutely. I mean, you mentioned the definition of inflation as too much money chasing too few goods and services, right? Or you alluded to it,
yeah.
Which I think is the common definition of inflation, and it is a good starting point. But as is the quantity theory of money, But as you said, and as we discussed earlier with supply chains, it might be a better idea to look at the specifics, right? What's going on in supply chains, what's going on in the labor market, what's going on in the financial markets, and things like that to get a better understanding of inflation.
Yeah, okay, excellent. Well, that leads us to a nice segue into the next section, which is about the labor markets and sort of still the demand pool angle, but then from the Phillips curve's perspective. But before we get into that, what do you think about fiscal stimulus in particular? Do you think it will reverse, or do you think it will remain fairly loose?
I'm cautiously optimistic about this, and I've been actually very surprised by the extent to which governments have expanded social insurance. I mean, in the USA, which of course us Europeans always like to, take the piss out of them for not having a very good welfare state, they have actually seen poverty decline during the pandemic. And you've seen Biden come into office, and he seems to be quite keen to expand spending, and in areas like care and renewable energy, as well as the typical infrastructure. So, and in the UK, you've seen Rishi Sunak with a moderate but an expansionary budget recently. So I am quite cautiously optimistic about this. Perhaps it's changed our relationship with government spending, because you don't see people worrying about the debt as much anymore, and maybe people are seeing that governments can do things, they can do more than we thought, and the money is available. So yeah, I'm kind of optimistic.
Yeah, and as a European, I would like to add there that weirdly enough, the European Union has also not gone into full austerity mode just yet. One thing that I do notice when you say this that I find interesting is you say, okay, I'm cautiously optimistic about continued government spending, but if that does cause some inflation, which in my opinion, there might be some inflationary pressures from that, especially in the United States, that is then an argument for team permanent, then a little bit for continued inflation somewhat from this side, right? If I hear that correctly.
So if governments continue spending, it might increase inflation. But actually, I mean, this relates to a bit of a broader point, actually, which is how we think about inflation. Because there's this resurgence, I think, of supply. We could call it supply side leftism or something like that, right? The notion that in spending money, perhaps by expanding capacity in renewable energy, for example, governments can actually expand the supply side as well as the demand side. And so therefore we might see, growth without necessarily excessive inflation. I mean, I'm willing to believe that inflation might rise to, 3-4%. That's something I'm willing to tolerate. But in terms of too much inflation, as long as the government spending is oriented on the supply side as well as the demand side, I don't see that as necessarily happening.
Yeah, okay. Just to tie that into the quantity theory of money before we move on, that is an argument that you're saying, well, actually, Q will be rising partly from an increase in M through government spending then, right?
Yeah, exactly. And this is one of the things with the quantity theory of money, right? If everything's kind of changing at once and not independently, then it becomes less useful as a guide to policy.
Yeah, totally agreed. Okay, now let's put a different spin on the demand pool inflation channel. Are there any non-monetary ways that overall demand can start to outpace overall supply? Yes, the theory of inflation that's most popular in universities at the moment is related to the Phillips curve. The Phillips curve plots the relationship between unemployment and inflation. The idea behind this is that if unemployment is low, the economy is running at close to or at its full capacity. This means that workers have a lot of money to spend, but that production can't really be increased much further. So while wages are likely to rise in this scenario with labor in such high demand, supply is not likely to be able to keep up, and therefore we will see demand pool inflation. If this is true, we should now see signs of an overheating economy such as labor shortages, trucker shortages and whatnot. But do we? Well, let's have a look at the evidence. Both in Europe and the United States, while unemployment shot up like crazy after the pandemic hit, it has now almost come back down to the low levels that it was at before the pandemic, when there really wasn't a lot of inflation. So that is not particularly alarming. However, unemployment rates might not tell the full story here because they only include people who are actively looking for a job. It could very well be that workers just don't feel like returning to the workforce, or more likely that they have retired early. Like roughly 2.4 million people apparently did in the United States. So then we should see a drop in the percentage of the population who works. And indeed, the labor force participation rate in the United States has dropped and not recovered by nearly as much as the unemployment rate. In Europe, however, this is less obviously the case, and indeed it didn't have that many early retirements. Perhaps because those lazy Europeans already retired much earlier than Americans anyway. But despite these differences, there are plenty of reports that point to labor shortages in both the United States and in Europe. But these could very well be temporary due to the massive shifts in the fortunes of different sectors. In other words, while highly skilled pilots are still unemployed by the thousands, there is now a massive shortage of medical workers in many countries. And so indeed, in the USA, wages are rising. However, in line with expectations that there is a large labor force left in the whole of Europe, in some of the core countries like France and the Netherlands, wages are not yet rising that fast. The European exception is, of course, UE's home country of the United Kingdom, where wages are skyrocketing. But you know, they decided to kick out most of their European workforce in the middle of a pandemic. But again, the teams disagree both about how serious these labor shortages really are and how long they will last. On the side of Team Transitory, people like Joseph Stiglitz argue that the tight labor market is a good thing, but it will likely come to an end because fiscal support is coming to an end soon. Now, hitting back for Team Permanent, here's what Larry Summers believes about the numbers from the last few months.
Look, it's more evidence that we've got a problem, that the risk to the economy is overheating.
Well, he does admit that.
We have transient inflation, but it is an elementary fallacy to confuse the idea that we have some transient inflation with the false proposition that all the inflation is transient and we have nothing to be concerned about. If you look at things that are longer lasting, labor shortages, pervasive.
But why would they be pervasive? Well, here again, I think that Professor Goodhart and Dr. Pradhan make the most convincing case with their aging hypothesis. If their theory proves correct, we might actually see permanent more pressure on the labor market. So there we have it, the two views are clear. There are labor shortages, but there's disagreement on how serious they are and how pervasive they will be. And perhaps even if they are a bad thing at all. Joeri, what do you think?
Yeah, I think, once Larry Summers comes into the picture, I'm just inclined to disagree with him. I think even if he said the sky was blue, I'd probably end up pointing out some of the finer hues in it. But I do think he's wrong on this. I mean, firstly, I think one of the big facts here that we haven't mentioned yet is if you look at monthly inflation, right? It did peak a couple of months ago or a few months ago, but it came back down. Mm-hmm. And now it's more at the kind of usual rate of monthly inflation. This is in US data, by the way.
Right.
So, that's a big fact, I think, in favor of Team Transitory that needs to be noted. But to the point of the labor market, I mean, one of the things that people like Larry Summers seem to underestimate is the issue of disguised unemployment. And I think we've seen a massive growth of disguised unemployment, especially since the 2008 financial crisis. For example, as you know, the unemployment rate is calculated as a percentage of the labor force. But when people get discouraged from looking for a job so much that they just give up, they end up dropping out of the labor force, so they're no longer counted as unemployed. And you've seen the labor force decline over the past decade or so. You see people working in jobs that are, really insecure. They're not really what people want to be doing. And so you get these kind of disguised unemployment. And what we're seeing, I think, with the boom is that people are starting to say no to these jobs. Right, and it's become a bit of a meme. You see all these tweets about what I texted my boss and things like that, and people are just basically starting to move from jobs they don't really like into jobs that they do like. So I think there's more slack in the labor market than people like Larry Summers are letting on.
Yeah, Yeah, and this is also something, and this is purely anecdotal evidence from my side, but I am in the Netherlands where, which is somewhat of a bit of the core of the Eurozone, where there's also supposedly very large pressures on the labor market, and you do see it. You do see in restaurants looking for staff and all of that. That is true, but if I look at some of my friends that are in, for example, logistics, which is very busy at the moment, it is easier for them to find a job, true, but they still need to apply for multiple ones before they actually find their way, and then sort of they do report that their previous employers who were terrible are having difficulty finding people. But, you know, these are terrible and they are paying the lowest of the lowest wages. So it really seems to me that this is perhaps a very welcome situation.
Yeah, I mean, you know, full employment for me is a really good, not just economic policy, but it's a good social policy. I mean, you see things like, for example, former criminals now getting employed much more easily and things like that, and therefore, you know, that helps them to get you know, back into kind of normality in some sense and things like that. So yeah, I do think that this is largely a positive thing. Inflation is subdued, and I think we've just got used to a situation where there's almost an underclass who are basically begging for terrible jobs, and you know, now the employers and the industries which aren't particularly desirable to work in are finding that people are telling them no. And that's a surprise to them, and they're obviously going to complain about that. But I don't see that there are any huge effects on the rest of the economy or anything really to worry about, and largely it's a positive thing.
Yeah, and if we put our economist hat on a little bit, you could even phrase it like there is more of a balance in the labor market, right? Supply and demand both have a little bit of power.
Yeah. That's the economistic way of putting it. Supply and demand are in balance now.
Yeah, and so what do you think? Will this persist, or do you think the labor market will shift back again to more employer power?
I mean, I think it's a really good question, isn't it? It goes back to what you were asking about, will fiscal policy persist? I mean, my answer is that it will persist as long as we maintain a kind of expansionary fiscal policy, and as long as things like social services are being invested in more, we will see this continue. The crucial question is that going to happen? I mean, it reminds me of Michael Kalecki's famous essay on full employment, and how it can basically, once it starts to favor labor too much, then the capitalist class or businesses or whatever you want to call them, they'll tend to turn against it, and they'll tend to think it's a bad policy, because even though it's having a positive effect on the economy as a whole, it's actually having a negative effect on their profits. It's squeezing their profits, and it's having a negative effect on the power that they can exert over laborers.
Yeah, and you do see a bit of signs of this, I guess, especially in the US, right, where the main voices that are pushing this overheating labor market demand are often very wealthy investors, then screaming that this will cause inflation, which is very bad for the poor. So that was that. The teams clearly agree about the role of supply chains. However, there's broad disagreement about whether aggregate supply is really too low or whether aggregate demand is really too high. This doesn't really surprise me because the data is not strongly supporting either position. After all, we have seen that there are labor shortages in many sectors, but unemployment is not really shockingly low, especially not in Europe. Also, aggregate real consumption in Europe is still below its pre-lockdown trend, and in the USA it's almost back on trend. This is not what we would have expected if the money printing story was true. Finally, industry is still producing quite a bit less than they potentially could in both Europe and the United States. Yet there is clearly a lot of inflation. But what if there's another explanation? What if this inflation story isn't about aggregate supply and demand? What if instead it's just about a massive shift in demand from services to goods? For example, in the USA you can clearly see that the real expenditures on services are still quite far below their pre-lockdown trend, whereas the real expenditures on goods are pretty far above it. How can such a shift cause inflation, you might ask? Well, it could be that for the categories where there are massive shortages, such as cars, prices shoot up. At the same time, services cannot really reduce their prices quickly enough because they rely on contract workers with a fixed income. In economics, this last phenomena is known as sticky prices. As you can see in this graph by Jonathan Nitzen, there might be some truth to this story. For example, the price of cars went up like crazy, whereas the prices of many services only declined marginally. This dragged the average price upwards. If this is true, then we should see an end to inflation after the pandemic has ended, whenever that is. Okay, now we've talked about the aggregate supply channel, the aggregate demand channels, and even about a shift in demand from services to goods. However, when it comes to inflation, there is one other factor that economists study very closely, and that is expectations about inflation. You see, what happened in the 1970s is that economists armed with the models of total supply and total demand were totally caught off guard by massive inflationary surge that they couldn't really explain by labor shortages or by a massive increase in oil prices or not even by money printing. So they had to come up with a new theory of inflation, and that was the theory of inflation expectations. And it goes a little bit like this. At the end of each year, you, as a worker, might at least expect a raise to compensate for inflation. Similarly, expecting inflation next year, businesses will want to increase their prices at the start of the year by at least some amount to compensate for that inflation. What will happen if people act on these expectations? Exactly, prices will actually go up and there will actually be inflation. It's this perverse dynamic that many members of Team Permanent fear for. Sure, they recognize that a large part of inflation today is supply driven. However, they fear that if these previous factors lead to higher inflation expectations and an increase in wages, inflation could accelerate on a more durable basis. Not surprisingly, Team Transitory begs to differ. They believe that the central bank, having presided over low inflation for decades now, has built up enough credibility to convince people that they will act if inflation becomes too high. Or as Treasury Secretary Janet Yellen puts it,
measures of inflation expectations, I think, still look quite well contained.
Also in Europe, inflation expectations are currently around 2.3% for this year and then fall back to below 2% for the years after. But yeah, you are probably wondering, what does UE think?
Well, I think, again, as with inflation itself, inflation expectations are quite low. So that's a kind of fact that needs to underpin this discussion. They don't seem to show any sign of rising and certainly not spiraling. It relates to this whole issue, which was actually raised with a recent paper by Jeremy Rudd at the Fed. Did you read that one?
Yeah, it was, I think, about, well, I didn't read the full one, but I think there was a bit of a Twitter storm surrounding it. And it was about saying that there's actually very little empirical evidence to believe that inflation expectations do play such a big role in actual inflation. Is that correct?
Yeah, absolutely. I mean, it got a lot of attention because it started with a general tirade against mainstream economics, but most of the paper was just about how we assume that inflation expectations feed into actual inflation, but there's just not that much great evidence for it. I mean, if you look at things like the time series tests, they don't necessarily seem to support this. All we have is a kind of correlation between inflation expectations and inflation, but of course that can go either way. People can just be expecting low inflation because they've seen low inflation. Yeah. And basically Rudd argues that what matters more to people is actual realized inflation. They may not be thinking about expected inflation unless it gets really high, right? And that's the area. And you mentioned the 70s and stagflation. You know, once inflation gets very high, it's noticeable. You know, prices are changing at the shop regularly. That's when people start to incorporate it into their expectations. But generally speaking, there's just not that good evidence that it plays a major role in most people's decision making. They'll just think about actual inflation.
Yeah, and what do you think about the differences? The difference with the 1970s, that at the time the power of labor in the form of unions was much bigger, so that if these labor unions expected inflation, they had much more power to actually demand that wages keep up with it, whereas now that's just totally not the case. So that inflation expectations might play a role, but just way less than they did then.
That's a really good point. I hadn't thought about that before, but yeah, absolutely. If you're, if you're a labor union, bargaining sector-wide or economy-wide, and you're thinking about wages, you'll obviously have a more sophisticated understanding of inflation, including expectations, than just the average worker. So it may have been that they played more of a role then.
Yeah. And finally, what about perhaps the more central bank positive story, where somebody like Yellen, I think, gets part of her confidence in inflation expectations being anchored, as she puts it, so being relatively stable, in that central banks have shown that they are able to control inflation, and hence people believe them, even if inflation is now a bit higher. What do you think of that?
Yeah, I'm not so sure about this one. I think that it may be the case that it matters for investors, especially. But I do wonder, how much control does the central bank have over inflation expectations? Again, they might be able to generally convince people that inflation has been low and it's going to remain low. If they were just to say, okay, inflation's going to be 10% or something like that, would people's inflation expectations, would they go up to 10%? I don't think so. So I think that I'm not so sure that central banks have as much control over inflation expectations as they're making out.
Right. Yeah. Yeah. Okay. Fair enough. And then finally, I think we should quickly talk about whether or not we think that the camp transitory or permanent has the upper hand when it comes to inflation expectations.
In a sense, it's team transitory, right? Because they haven't really gone up. They haven't even really gone up. Where actual inflation did go up. That's why people started worrying about it. But inflation expectations have actually been more subdued than actual inflation. So I think that, team transitory definitely has this one.
Yeah, but perhaps not for the reason that they like, in the sense that people might just not trust the central bank that much, but are just so used to low inflation that they won't immediately update their expectations, if I heard you correctly.
Yeah, absolutely. Yeah. So people aren't processing, all the real-time information about inflation and incorporating it into all their behaviors in the way that some economic models might assume.
Yeah, so I broadly agree with you there. The one thing I would like to add is that I actually think that if inflation is longer for a while, that many of the central banks will start tapering rather quickly, and that this will, if people, whether or not people sort of trust the central bank, will temper inflation expectations quite a bit if they start hiking interest rates or cutting QE.
Yeah, absolutely. Once the central bank starts to engage in contractionary policy, then they can reduce inflation, and that is likely if it gets much higher.
Now, before we conclude, we have to talk about the relationship between exchange rates and inflation. However, to be honest, most team members don't really talk about this. The reason for this is that they are from Europe and the United States, whose currencies are so dominant that these countries can import and export typically in their own currencies. On top of that, this relationship is just rather tricky to study. On the one hand, if your currency depreciates, your imports will be more expensive and so your prices will likely rise. However, on the other hand, if there is excessive inflation in your country, then the price of your currency will likely drop. So it's not entirely clear which causes which. That being said, the exchange rate channel of inflation is a major factor for smaller currency areas such as those of Turkey, Lebanon or Brazil. Countries with much higher inflation than Europe or the United States. Therefore, to do it justice, I think this topic deserves a video of its own. But for now, UE, who do you think made the best case? In learning economics, what do you think of these channels? Which ones do you think are the most important?
Well, I think that it's been pretty clear in every case that the data and some of the case studies seem to back up team transitory. It doesn't seem that inflation is persisting. It seems that it's gone back down. It seems that inflation expectations are also anchored, whether or not you think they have an effect. And I think team transitory is really the winner. However, I will say one thing, which is that elements of team permanent have drawn our attention to some important factors, and the pandemic itself has drawn our attention to important factors such as supply chains, which have maybe been neglected in our mainstream discussion of inflation. And so if I were to comment on how we think about inflation going forward, I would probably say that it would be nice to have a much more granular understanding of sectors, crucial sectors like energy, but also like microchips and computers and other things which underpin a lot of the economy, and to have a better understanding of labor, and that will feed into our understanding of inflation. So although team transitory, I think, are right in this instance, the way team permanent have shifted our focus can be a positive thing.
Yeah, I again broadly agree, and I didn't think to mention that before, but also I think when we just specifically look at the monetary transmission channel, which I think we both agree is just not that important anymore for current inflation dynamics, it is, I think, quite important for asset price inflation dynamics, and I think a lot of the passion that surrounds this subject is about asset price inflation, and especially house price inflation, which is quite terrible for people, and which is, I think, a serious problem, and for which ultra low interest rates and QE might have a big responsibility to bear. And I think that is it's just something that we haven't been able to integrate into our discussion of inflation, because that's just not what inflation is. Inflation is inflation of our daily costs and not of asset prices. But that doesn't mean, and I think I'm speaking for both of us here, but correct me if I'm wrong, that we don't think that asset price inflation is a serious problem.
Absolutely. And it goes back to the issue which we raised at the beginning, which is, what do you think of as inflation? What is inflation? Typically, we're thinking about the consumer price index, right? On the grounds that those are the prices faced by people when buying the things that they need. Obviously, asset price inflation can affect people as well. So that seems to have a relationship with monetary policy and quantitative easing. And perhaps one of the features of central bank policy has been, over the past few decades, has been a lack of focus on these things. So maybe they need to come back on the agenda as well. Yeah, I totally agree. And I think that it's also more likely that inflation is going to be temporary. And I hope that if any of these sources of inflation is the one that's going to be more permanent, it's the labor market one, where I think it would be good to have a bit more balance between supply and demand. And I really hope that especially the supply chain disruptions get fixed as quickly as possible. Yeah, I mean, if we see continued growth in employment, and we see, less slack in the labor market, we could be looking at things like the labour share of income rising, which is something that some economists like Larry Summers seem to think is, anathema. It's terrible. That shouldn't happen. That means that inflation is spiralling out of control. But actually, that could be a good thing, certainly up to a point.
But that's just our humble opinion. What is yours? Which inflation channel do you think is strongest today? And which team made the better case? Make sure to let us know in the comment section. And if you appreciated this video collaboration, consider checking out Joeri's channel. And finally, if you want to see more of these research-intense videos, consider supporting the channel via Patreon or Ko-Fi using the links in the description.